Anyway, so as usual, I have a little thing put together. I don't know if it'll be valuable or not. I'll try to be quick about it. If you have questions as I go through it, please don't feel bad about interrupting or anything like that. That's I'm more interested in answering your questions than I am getting through my presentation. And so totally fine with you asking questions. So let me just throw up there what I'm gonna throw up on the screen, what I'm gonna go over and get into it. So the part that's often confusing for people in this chapter is this concept of the issuance of bonds. I know when I was studying for my Series 7 brokerage license, the bond interest rates and bond price fluctuations was one of the hardest things for me because it's just not something most of us deal with ever. So first of all, recognize that a bond is just a loan. Okay, so if a business issues a bond, that means they're loaning money. Borrowing money from other people. That's what it means when you're the issuer. It means that you're borrowing money rather than borrow money from a bank or something like that. Instead, what they're doing is reaching out to a transfer agent, usually a large investment company that will then sell shares or sell portions of this bond to investors, and we'll use that to raise capital. Anyway, so let's just talk about the process of when we issue a bond. So let's see. So when we issue a bond at face value, the face value means that that's the amount of money that we're borrowing and that we're going to pay back at the bond's maturity. Before we even get into it, so we have our face value. That's the amount that we will pay back on the bond at maturity. We have the maturity length. So this bond is a 5-year, meaning we'll have to pay back that face value in 5 years. And then we have a face interest rate. In this case, it's 10%. You can't really get bonds for 10% right now, but it makes the math easy. That's the amount of interest that's going to be paid on the bond. So this says they issue 100 $1,000 bonds, meaning a total of a $100,000 bond issue. So when they do that, and you can either issue bonds at their face value, meaning you're going to get as much cash now as you'll have to pay back at maturity, or you can do it for a premium, meaning you'll get more cash now than what you'll pay back, or at a discount, and we'll talk about each of those three. So when we issue at face value, it's simple. Our cash goes up by the amount of the face value, and our bonds payable also goes up by the amount of that. So that's the issuance. And then the next thing we'll have to do is record interest each time the bond pays interest. So if we issued this bond on January 1st, most of the time bonds pay interest semi-annually every 6 months. Although it looks like this one might only pay it once a year. So our interest expense is going to be $10,000 per year, or the face value, the principal, times the rate, times the amount of time. And so for 1 year, we'll have $10,000 worth of interest. So at December 31st, we would record that as an interest expense of $10,000 and an interest payable of $10,000. All right. So now when they pay their interest on January 1st, we'll get rid of the interest payable by debiting the account and credit our cash, $10,000. Most of the time, bonds pay interest every 6 months. That's just a norm for bonds in the real world. And so you would do the same thing, except you would just do 6 months worth of interest payment each 6 months. All right. So sometimes, though, what happens is businesses decide they're going to issue a bond, which means they're going to borrow money. And then there's this process where they have to get the bond all set up and issued. And during that time frame, market interest rates can fluctuate. They can go up or they can go down. Like right now, if I decided I was going to issue a bond last week and started doing the paperwork, and then the Fed cut interest rates down to 0 for the Fed funds rate, that might have an impact also on bond rates. And so I would have to adjust the price of my bond so that it's still paying the same, roughly the same amount of interest as the market rate. So here's what you have to remember. The bond rate, the face rate, the one that's printed on the bond, stays the same. Once that bond is printed, that amount stays the same. So this bond's going to pay 10%. So if market interest rates drop, here's an example, the market interest rates drop to 8%, then our bonds are going to sell at a premium. They're going to sell at a price higher than what the new bonds coming out at the market interest rate are. And here's why. Because I've got a bond paying 10%, but all new bonds are going to be issued at 8%. So my bond is worth more. It's more attractive to investors because it's paying a higher rate of interest than what the market interest rate is. Conversely, if the market rates go up, so now I've got a 10% bond, but new bonds that are being issued are paying 12%, then my bond's going to sell at a discount, meaning it's not as attractive as the other bonds that are coming out now. Because what happens is a lot of times, I think, what a business will do is they might get approved to do $1 million bond issue, but they don't want to issue all of them if they don't need to. They don't want to borrow all that money if they don't need to. So they'll do the first 500,000 and then kind of sit on the other ones and then decide, oh, we need to issue out some more of those. Well, they're already printed at a 10% rate. And so in the meantime, the market interest rates fluctuate and change. So that's the whole idea behind bond premiums or discounts. So let me show you the journal entries that go along with those. So here we have on January 1st, go ahead.
Just before you go into the entries, can you go back to that other slide?
This one?
Yeah, I didn't understand the premium and the discount. It was easy for me to get the concept of the face value, but I didn't understand the premium and the discount. How does that work in the real world? Like,
sure. So if I have a bond, let's just say I have a bond, let's just follow the example we have on the screen. If I have a bond that has a face rate of 10%, that means it's going to pay 10% interest on the face value of the bond. And so in the meantime, the market interest rates fluctuate. They drop to 8%, meaning all new bonds being issued are now going to pay only 8% on their face value. So now I have this bond that pays better than the market interest rate of all new bonds coming out. So what I do to account for that and to save myself some money as the issuer of the bond is I will sell the bond at a premium. So for example, I will sell the bond at, let's say if it's $100,000, I'll sell the bond at $102,000, and people will buy it at $102,000. They'll still get 10% based on the face value of $100,000, and then I'll have to pay them back the $100,000 at the end. So in essence, what we're doing when we sell a bond at a premium is we're marking up the price of the bond. And what that does, if you think about it, is it brings down the effective interest rate we're paying to the market interest rate. So even though I'm paying 10% on the bond, the fact that I got more for it when I issued it and still only have to pay back the $100,000 reduces my cost of borrowing as the bond issuer. Does that make sense or no?
What I'm confused is, with the example, I was confused. Okay, so you are like borrowing,
right.
So you're getting these bonds, and that means that you're raising money by, how does that work? Like, I'm very confused.
Sure. Okay, so the way this works is, so for example, in my hometown here, the schools built a big auditorium. They called it the Center for the Arts. And it costs like $6 million to build. Well, the school district didn't have $6 million. And the bank wasn't going to loan to the school district. So instead, what they do is they reach out to individual investors throughout the community and throughout the state. And maybe one investor will put up $1,000 and another will put up 10,000. And so what they do is they go through a brokerage firm, and that brokerage firm structures a bond. And so the school raises money to build their auditorium by selling these bonds to individual investors. Those individual investors get a bond certificate that in essence guarantees them a certain interest rate based on the amount that they invested, whether it's, say, $1,000, and then also guarantees them the face value of that bond back at the maturity date of the bond. So that's how a bond works, is the person issuing it, the issuer of the bond, they're borrowing money. So when I issue a bond, it means I'm issuing kind of like a note payable, this bond certificate that promises that I will pay back the face value of that bond plus a certain amount of interest, each year.
Okay, that does make sense. But
okay.
Then how do you apply that to the premium and then the discount?
Sure. So let's say the school district borrows their $6 million they need, but the construction of this center actually takes 2.5 years. So what they do is they sell the first offering of bonds. Let's just use these numbers, and let's say all the bonds guarantee that the people who invest in them will get 10% on the face value, plus they'll get their face value back at the end of 10 years. Okay, and so when they sell that first $1 million worth of bonds, the market interest rate matches the face value and the face interest rate on the bond. So what they do is they sell them at the face value, meaning they sell $1 million worth of bonds for $1 million. That's it. Then the next year they decide they go into phase 2 of construction. They have to issue another $1 million worth. Those also say 10%, but now the market interest rates have fluctuated down to 8%. So when they do that, they realize we don't want to pay 10% interest on this money if the market would only charge us 8%. So what they do is they mark up the prices on their bonds. So they'll sell that $1 million worth of bonds for $1.2 million. And so now a person who invests in those bonds pays what's called a premium. They pay above the face value of the bond. Maybe for every $1,000 they invest, they'll pay $1,200, but they'll get 10% on the face value, and then they'll get the $1,000 back at the end. And what this does is it lowers the cost of borrowing the money for the school to what the market interest rates are.
Okay.
Still confusing?
Not very clear, but I think I just need to practice and it will be clear.
Okay. Yeah. The big rule to remember is, remember that the interest rate that's on the bond, they call it here on this slide the bond contractual interest rate. I call it the face rate, the amount that's printed on the bond. That doesn't change. But market interest rates, they fluctuate up and down. And so if you just remember that market interest rates behave inversely with bond prices, that will help a little as we get into doing it. Meaning if market interest rates drop, then bond prices go up. So
they're premium.
Right. And if market interest rates increase, then bond prices drop, and so the bonds are issued or sold at a discount. So if you just remember there's this inverse relationship between market interest rates and bond prices, that will help a lot as we move forward. All right, so let's look at an example and maybe it will help. So here we have Candlestick Inc. sells $100,000, 5-year 10% bonds at 98. So just so you know, what bonds get listed at a percentage of their face value. So if it says a bond is selling at 98, that means it's selling at 98% of its face value. which means it's selling at a discount of 2%. Okay. So what they would do is they would show that they received $98,000 in cash. Cash is debited $98,000. And then there's a debit to something called discount on bonds payable. And then the bonds payable account of $100,000. So the discount on bonds payable is a contra liability. So it's always linked together with that liability, bonds payable, but has a normal balance on the debit side. In the balance sheet, it would look like this. It would show bonds payable of 100,000 less the discount on bonds payable, and then it would give a book value of 98,000. That's the amount that they owe as of, you know, the time this balance sheet was made.
Can you go back to that previous slide?
Sure.
Sorry.
Nope, that's okay. That's
No, the other one. Yeah, so in that one, where, can you help me spot where the discount is? Like you said that if the interest rate is different than the market rate, and then the market rate higher than the interest rate, then there's going to be a discount. So right. Where is the discount?
So on this one, they do the work for us. Instead of telling us all about the market rate and the face rate, they give us the face rate of the bond of 10%, but then they tell us that it's being issued or sold at 98. So that's telling us that we're selling the bond at 98% of its face value. So the discount, so if we get $98,000 in cash, but the bond payable is $100,000, then the difference between those two is the discount on the bonds payable.
Okay.
So rather than tell us, I don't think that they're going to have us actually calculating the amount of discount using future value and present value tables in this chapter. That's an appendix item that I don't think they'll have us do. So instead, these problems will tell us the amount of the discount or the premium.
Okay.
So what we have to do then is we have to amortize the bond discount. Amortize is like a fancy word that pretty much means the same thing as depreciation. It means spreading it out over the life of the bond, okay? So what we do is we always do this in a straight line. We take the amount of discount and then we divide it by the number of periods. Either it depends on how the bond pays interest. If the bond pays interest semi-annually, it would be the number of semi-annual periods in the bond's life. Or if the bond pays interest annually, it would be the number of years in the bond's life. And then we amortize or claim the expense for that discount over the bond's life.
I thought amortization was intangible assets.
The term is also used for intangible assets.
Okay.
But it just means to spread the value or the cost of something out over its useful life, very much like depreciation does.
So you're saying we probably wouldn't have to figure this out, they would just give it to us?
Well, in the sense of, like, it just told us the amount of the issuance, which is 98%. So that means that the 2% is the amount of the discount.
Right.
Okay.
Just the self-study doesn't go over that part, and so I haven't read that part yet.
Okay. And so what we would do then is we would take this $2,000 discount, we would divide it up by 5 years, and we would amortize or recognize this discount as a $400 expense per year over the life of the bond.
Because you divided that by 12.
No, by it's a 5-year bond.
Oh, sorry, by 5.
So, yeah, so each year we would recognize, because think about it, if I only get $98,000, but I have to pay back $100,000 at the bond's maturity, then this discount is an additional expense involved in borrowing the money. So each year I'm going to debit I'm going to call it interest expense, and I'm going to credit the discount on bonds payable account, $400 a year, so that by the end of the bond's useful life, all of that $2,000 will be claimed as an interest expense. That's how we amortize. Let me get back down to that. The discount on a bond. So we allocate to expense in each period. It's going to increase the amount of interest expense reported each period. Again, maybe the best thing for us to do is after we talk about it, to look at one of the problems and do an example of it. Otherwise, it's all just kind of academic. It's all just talk. We can also issue bonds at a premium. So here, Candlestick Inc. Sells bonds at 102 rather than at 98. So now what we're saying is this bond is being issued at a 2% premium. So we're getting $102,000 in cash, and our bonds payable is $100,000. And so the difference is the premium on bonds payable. So premium,
So
go ahead.
if this was for your, like, related to the example you gave earlier, so they're receiving, the school district is going to receive $102,000, but they're only going to have to pay $100,000.
Correct.
But why is it called premium? Wouldn't it be more clear to say, oh, you don't have to pay $2,000, so there's a discount on bonds payable?
Well, no, because so we're speaking again from the viewpoint of the sales price. Okay, the premium means that it's selling for $2,000 above the face value.
So who's making this entry? Is it the school district, or would it be the? Oh, it is?
The issuer of the bond, who is the borrower. So
Okay.
when they borrow this money, they're getting $102,000 in cash, but recording the bonds payable only as $100,000 because that's what they'll have to pay back at maturity. The difference is this premium on bonds payable, which we're going to amortize.
Oh, okay.
Okay, and it's going to actually reduce the amount of expense we have. So when we issue it as a premium, it means it's actually costing us less to borrow the money. When we issue at a discount, it's actually costing us more to borrow the money. And again, people don't do that just because
premium is less.
Just because they want to. They're doing it because the market interest rates have fluctuated, and that's the going price for bonds now that are paying that face rate. So this is what it would look like on the balance sheet. Bonds payable, and then we plus the premium.
So we only amortize the premium
or the discount.
Or the discount?
Mm-hmm.
Okay.
So you said premium we owe less and discount we owe more. Is that?
Well, premium, we owe $100,000 either way.
Mm-hmm.
Okay, because we're issuing $100,000 worth of bonds. If we issue them for $98,000, we still owe $100,000, but we only got $98,000. So we're going to have to pay back an additional $2,000 more than what we got, plus the interest. Okay. Whereas if we issue them at a premium, so we issue them for $102,000, we get $102,000 in cash. We still have to pay back the same $100,000, but we got an additional $2,000. Which again, if you think about that, it reduces the cost of borrowing the money.
So premiums reduce cost of borrowing.
Mm-hmm. And
so where do these, where do they usually put the $2,000?
What do you mean?
Where
they just use it?
Yeah, but where does it go? Because doesn't it get little, like, spread out?
Yeah. So when we amortize it, what we're going to do is it's going to decrease the amount of interest expense reported each period.
Oh, I see.
So what we do is we take that same $2,000, divide it by the useful life, in this case 5 years, so $400 each year. What we're going to do is we're going to credit the premium on bonds payable account, $400 each year, and then, I'm sorry, debit, I apologize, the premium on bonds payable account, and credit the interest expense account. So each time we pay interest, if you think about it, when we pay interest, it's going to be the face value, $100,000 times the face rate, 10%, so $10,000. So our premium then is going to reduce that expense. So we'll actually only have, if our premium amortizes $400 per year, we'll have $9,600 in interest expense each year, and reduce that premium until it's, if we do $400 a year over 5 years, that account will be down to zero. Like I said, I think if we do an example problem, it'll become clearer. One other thing is when the bond becomes mature, if we, all we do is our bonds payable goes down. So we debit bonds payable, and our cash, I'm sorry, and our cash goes down. So we credit cash. So that's how it is to pay off the bond at maturity. And then if we redeem the bond before maturity, we have to do what's called eliminating the carrying value of the bond, which is record the amount of cash paid, and then we have to debit the bond's face value, that's to pay it off, and credit any amount that was in the, we'll debit or credit any amortized premium or discount. And again, this is going to sound confusing until we just look at an example, okay? And then the difference between the amount of cash we received and the carrying value of the bond is either going to be a gain or a loss. So let's move to an example in the homework. Well, they have it. I think this is, let's move to an example in the homework. So give me a minute and I'll pull that up. I think maybe we're talking about it too much and not actually doing it enough, and I think that makes it confusing.
That exercise, homework part 2, and I believe is the last one. That one is a good one because it talks about the bonds payable, I think.
Mm-hmm.
Maybe it was notes payable. No, mortgage payable, and that was
Yeah, but that's not the one I want to do first, because it's not about what I'm talking about here. So give me a second. We can look at that one too, although that one was part of the homework support groups, although a lot of people struggled with it.
I don't think that one was part of the...
Yeah, 10-12A, that's one of the videos.
Unless someone in your group didn't do theirs or something, that's possible.
She couldn't figure it out. She posted the video, but she couldn't figure out how to do it.
Right, but then I posted in there, didn't I?
Yeah, you did. But I was just reading the text, and I sort of understood, but I just wanted to see like your way of thinking.
Okay, so let me finish this thought on bonds, and then we can look at that 10-12A.
I have some questions on today's too.
So let's see. All right. So let me share my screen again. Maybe, if I can find the right thing here. I'm working off my laptop, so it's different than what I'm used to, and it takes me a minute to find stuff. All right. All right, so this is 10-13 on the part 2 of the homework. So we have Sand Hill Company issues $490,000, 7% 20-year bonds at face value. So prepare a journal entry to record the issuance of the bond. So at face value, it's super easy. Your cash goes up by the face value, and your bonds payable goes up by that same amount. If only they always did it that way, it'd be great. And then it wants us to record the entry to record the accrual of interest at December 31st. So what we have to do is say, okay, this bond is $490,000. It pays, what did we say? 7%. So our interest for 1 year is 490,000 times 7% per 34,300. So at December 31st, we have to do an adjusting entry to record that accrued interest because it's not actually going to pay out till January 1st. So we're going to do an interest expense of 34,300 and then an interest payable of 34,300.
I have a question about that.
Yeah.
Maybe that's what you just said, but I'll ask anyways.
Okay.
So if somebody issues, is it right to say issue a bond, like to borrow?
Correct.
Is that how it's, okay. If somebody issues a bond, then do they pay all the interest at the end of the 5th year, or do they pay at the end of each fiscal year?
Right. So it depends on the terms of the bond. Normally, bonds pay interest either semi-annually or annually. And so they would either pay every 6 months, a cash payment, or every 12 months. This bond just happens to pay every 12 months.
Okay.
So when they actually pay their interest, then the next day, that's why I always hate when they do these on December 31st, because I had to do this whole adjusting entry, and then the next day I have to go back and say, oh, now I'll actually show the payment of the interest. So the interest payable will be debited, interest payable account will go back to 0, and then my cash will go down. And then finally it says at maturity, we're gonna pay off the bond. So now our bond payable will go down, debit to bond payable, and then our cash will go down, a credit to cash. So that's a really kind of I guess a simple example of a bond being issued at face value. And then let me see if I can find one where the bond is issued at a premium or a discount. I thought there was one in here, but I'm not seeing it. Because the brief exercise is also at face value. So maybe we don't have a good example of them issuing it at a premium or a discount. Let me look in the first homework. Did you see, was there an example of it in the first homework?
I don't remember.
Okay.
I don't think so.
I don't think the bond.
Which would be awesome if we, which would be awesome if we thought, oh, well, good, then we don't have to worry about that. But you know, they'll like bring it up on the exam after it wasn't in the homework or something, which would be a dirty trick.
Yeah.
But
the first one, I found it to be more, I found it to be easier than the second part, the first part of the homework. So I don't think I didn't have any problem.
Okay. Yeah. So I don't see a good example I can use right now. Maybe of when a bond is issued at a discount or a premium. Maybe I'll take a look at the exam questions and see how much that's addressed, and maybe try to see if we can address that more. I for some reason I was thinking there was one in the homework, and so it's possible they've changed it since, or I'm just confused, not remembering correctly. Let's look at 1012A then and see if I can answer your questions there.
Is that on part 2 you're talking about?
Yes.
Okay. That's
and
where I'm at right now.
Ging had a question about it. Right, Ging? Yeah. And it's not this first part A, right? It's this down here, part C.
The last one, yes.
Okay. So in essence, what they start you with doing an installment payment schedule for this note payable. And then they jump you into a journal entry for the note payable. And then down here at the bottom, they want you to do like a partial balance sheet at December 31st, 2017. So what's confusing about this is, so the first thing you have to do is you have to figure out what your total liabilities would be as of December 31st, 2017. Sorry, hold on. All right, sorry. That is my elders quorum president probably calling to see how my ministering families are doing. I told him I have time anytime today. I'm off today, and then he waited till right now. That's how it always goes in life, isn't it? All right. So the first thing we have to do is I have to look up here at the top and say, all right. So here we purchased a piece of 440. Somebody else is getting called about their ministering right now. $440,000 piece of equipment was $66,000 down, which means they received cash of $374,000. So that's the amount they borrowed. And it was a $374,000 loan, 6% on a 5-year note. And then there'll be annual installment payments of $88,786. So I'm going to bring up an Excel spreadsheet and try to walk through this. It's a little bit complicated. I know everybody loves complicated things in their lives. That's why he decided to take college classes. All right. So the amount I borrowed was $374,000. Right, that's the principal of the loan on the day the loan was issued, which was January 1st, 2017. Now, at the end of that year, 2017, so at December 31st, a couple things happen. First, I have to make my payment, right? And that payment, the total payment is going to be $88,786. That's the amount that gets paid each year. Now, a portion of that payment is going to be interest, and the rest is going to reduce the amount of principal on the loan. So to figure out the amount of interest, I'm just going to take the amount that I owed at the beginning of the year times the interest rate for the year, and that's going to tell me how much interest I have to pay in that first year. And then the amount of principal is just going to be the total payment amount, 786, minus the amount that was interest. So the two of those together should add up to my total payment of 88,786. Okay, so the amount I owe after the payment, so
your new principal.
My new principal balance at December 31st after the payment, right, is going to be the old principal balance minus the amount of principal that happened in the payment. So now I owe $307,654 as of December 31st, 2017 after my payment. So the question down here is, they want us to do this balance sheet. And so we have to figure out what part of this is going to be current liability, meaning mortgage payable that's due within the next year, and which part of it is a long-term liability. So what I have to do then is I have to figure out what my payment at the end of 2017 will be. I mean, at the end of 2018 will be. So that payment, December 2018, and actually I've already figured that out up here, right? When I did my payment schedule, how much of that will be interest and how much of that will be principal in the second year. So my interest in that will be 18,459, which I could figure out if I needed to, again, just by taking the amount I owe times 6%. And then the principal amount of that payment is going to be 70,327. This amount, 70,327, this is the short-term portion of this note payable. Right? This is the amount that I'm going to have to pay in the next year on the note payable. So if I look down here, I'll have current liabilities on the mortgage payable are 70,327, and then the remainder is going to be long-term. And that remainder,
So
see
you're
right here, 237,327. So in essence, what we have to do for 2018 is it just wants us to break down what portion of this 307,654 has to be paid in the next year, which will be the amount that is the principal payment on the note this next year. And then what portion will be long-term, which is the amount that's going to be carried forward into future years.
So is that your principal balance, your 307,654 minus
minus the amount of principal to be paid next year.
The 70. Okay.
So we could say this is the principal owed at the end of the year minus the amount of principal we're going to pay in the next year is the long-term portion of the note. Ging, does that help clarify or no?
It does.
Okay. Yep. I think when I gave the explanation, I tried to show how I figured out each of these amounts. But when you look at the problem, you can actually see that you actually did the work of figuring it out up here in the payment schedule.
What confused me was the number.
I think I may have lost you guys. I'm not sure if you can hear me, but I'm not hearing. Wait, are you back? I think you're back. What did you? So Patricia, I heard you say what confused me, and then I didn't hear.
Oh, okay. No, what confused me was the numbers on the left: 1, 2, 3, 4, 5.
They should have put years or something.
They should have put
Right.
like the date or something.
Yeah, I agree. That's a little bit confusing.
But the way you solved it on the Excel spreadsheet, that was really, really easy to see.
So what? I'm sorry.
It was really easy to see. I don't know what's going on with the internet.
It could be me too. I don't know if it's you.
I can hear just fine, so it's probably yours.
Yeah, no, I'm working from home when I'm usually working at my office, and I'm on Wi-Fi as opposed to at work. I'm usually plugged in, so it's possible that with Netflix running in that room and YouTube running in that room, and that there's a limited amount of bandwidth here. Okay, so hopefully that clarifies. So Janice, you said you had some questions on the first homework assignment?
Well, I did. Let's see. Let me get out of this so I can look at it. Sorry, I have to go back to it. I was in 2 while you were doing that. Oops, week 11. 11, part 1. Let's see. Okay, yeah. So I'm glad you reminded me of that because that made me find what I had questions with. So on 10.10-5 part level, I've got like all the numbers right. I've got most all of it right, except for oh, now I'm looking at 10-1A. Hold on, I gotta go back. So 10-5 is the payroll, the salary and wages expense. And so the first line, you put salaries and wages expense, which is the total that they earned, the 78,000. And then it's broken down by all the FICA payable and federal income tax payable, state income tax payable, union dues payable. And then the last one that it lists is state unemployment taxes payable for 853. And I put that in there and it says, no, we're sorry, we listed that, but that's wrong.
So where?
So it's part 1, 10-5.
Part A or?
Part.
So there's
more on that.
Yeah, there's two different things going on here. Okay. So I'm not sure. So the first
Okay,
thing.
so I have the salaries and wages expense. Then I have the FICA. I have the federal. There was no state. Let's see. There was state income tax payable. Salaries. So why? I guess what I'm asking, if I look at mine, is so mine has the earned wages, then it says withholdings. So it lists the FICA, FICA, whatever you want to call it.
I call it FICA, but I won't judge you.
Okay.
You can call it whatever you want.
So I did a credit for FICA taxes payable. Then next it listed federal income taxes payable, which I did a credit for. Then it says, oh, sorry, and I did a debit for salary and wages expense. So after federal, it lists state income taxes payable, so I put that. Then it says union dues. So I put that as a credit. All of these payables I put as credits. Then there's one last payable, which is $853 for state unemployment tax, but they don't leave another line to do what I'm seeing on yours, which is the salary and wages payable. There's not an extra line, so am I supposed to leave something out?
Yeah, so the state unemployment tax is not going to be covered in this first entry. So, and let me look at this. Let me read through it a little bit here. Payroll tax expense and so
why isn't the unemployment tax put under that first one?
Okay, well, because those are payroll taxes. So here, these are all our salaries and wages expense. Okay.
Okay.
And so then you see all of these that offset this expense are payables. Okay. Because our employees earned wages of $85,000. So that goes right here. And then we're withholding all of these taxes from them. So and that's why what they do is they offset the amount of money we're actually going to have to pay out. So even though our employees earned 85,000, we're going to pay out 63,888. But these are all things that the employees have to pay. So we're withholding them from their paycheck. Okay. Whereas so this is the employee's half of FICA, right? With FICA, the employees pay half and the employer pays half. So this first entry just shows the total amount they earned, the total amount we're going to have to pay, and then less all of the withholdings for that.
So they're taxes, but the unemployment tax isn't something that that's something that the company pays, and that's why it's not listed.
Correct. So these are the things that the employee pays. And then down in part B, we're going to handle our half of FICA and the state unemployment tax, and we'll debit all of that as a payroll tax expense.
So the employer is the one that pays the state unemployment taxes payable. The employee doesn't get that deduction from their paycheck?
Correct. In most states, the employer pays into federal and state unemployment taxes, which is then if somebody ever loses their job and has to go on unemployment, that's where that money gets drawn from. So
does it say above the employer's half of the FICA taxes, or do you just assume that we're paying half and they're paying half?
that's
It doesn't say they pay half and you pay half.
correct. That's just the norm. So in essence, whatever you withhold from the employees, the company has to match that amount.
In reality, they're getting what, like 13,000? Is that what
You mean they're paying
the FICA taxes?
They're paying $13,006 to the federal government. So $6,500 withheld from the employees and another $6,500 paid by the employer. This is especially tough for people that are self-employed, right? Because now they have to pay both halves of that. So it begins to be a pretty big tax. If I pay myself $10,000 in a month, then I have to pay 7.65% of that as an employer, and I have to pay 7.65% of that as an employee, and it starts to be pretty hefty if you're self-employed.
Okay, were there only two parts on that problem?
Yes.
Okay.
Yeah, so the difference happening there is the first part is what the employee is paying, what we're withholding, so the employee pays it. And the second part is the expense to the company itself.
Company's payroll tax expense. Okay. So then on, my other question was on the last part submission. On January 12th and January 14th and on the 12th and the 14th, the debit accounts I don't have correctly, and then on the 20th I don't have the credit account correct.
Okay, let me read through this. So we have these liability accounts. So on the 12th, we performed services for customers who made advance payments of $12,500. So what this requires us to do is to think back to
revenue.
Right, to think back and say, okay, now that we've actually performed the services, we're gonna credit service revenue and we're gonna debit the unearned service revenue account. Because back in the past, when we received the advance payments, we would have recorded those as our cash going up, so a debit to cash and a credit to unearned service revenue. And now that we're earning it, we're gonna debit unearned service revenue and credit our service revenue account.
Well, we credit service. We debit unearned service revenue?
Because back when they paid us the money, we would have credited unearned service revenue, right, as a liability account.
Okay.
And so now we're showing that we've earned that unearned service revenue, so we decrease the liability, unearned service revenue, by debiting it, and increase service revenue by crediting it.
Okay, and then on 14, we paid our sales taxes that we collected. So we've been collecting sales tax, and now we're paying it. So we're paying cash.
So as we collect sales tax, what we do is we show our cash going up and our liability, sales taxes payable, also going up. So then when we pay the sales tax, we actually pay the state for them, we will reduce the liability, sales taxes payable, so it'd be a debit to the sales taxes payable account, and our cash would go down, so a credit to our cash.
Maybe I just put sales tax and not the taxes, and that's why they marked it wrong, because that's what I had.
Because sales tax is never an expense to us, okay? We never record it as revenue, so we're not going to record it as an expense. Instead, just as we collect it, we increase that liability account, sales taxes
and then we just pay. Okay. And then 20 says, so we sold 600 units of new product on credit at 46 per unit at 6% sales tax. So I got the amounts right, and I got that we debit accounts receivable, we credit sales revenue, and I thought it was interest payable, like.
No, it would be sales taxes payable.
Oh, because it's a sales tax.
Right.
Oh, duh. I feel great now. Sales taxes payable. Because
it's that 6% sales tax. Then in essence, we're withholding, or
payable,
adding on to the total. So in essence, if you think about how this is written out on here, it shows I earned revenue of $36,040, and I collected an additional $21.62 in sales taxes payable, which means and since it's on account, it means I'm owed a full $38,202.
Because for the revenue and the taxes.
Right.
Okay. Go away. That was not supposed to open. Can't look at it because something else came up. Okay. All right, I haven't got to the rest of that problem yet, so I don't know if I have any issues with it.
Okay.
But I couldn't get past that first.
Okay. Ging, did you have any other questions?
No, I don't.
Okay. How about you, Patricia?
I'm good. Thank you.
Okay. So like I said, what I'll do is I'm going to look at the exam and see how deeply they go into discounts and premiums on the bonds, and make sure I get something out tonight. Even though I know it's a ways to the next exam, but just, I want to make sure that we're covering the concept as well as we need to, I guess. So what I'll do is I will post this video, and then I'll post like an addendum or like a reply in the announcements to this with any additional information that I think will be helpful for understanding discounts and premiums to the level that we need to. It's the kind of thing that a lot of things in this accounting class and in the next one you'll take that you'll learn and then you'll forget about, and then if you ever get a job that involves doing it, you'll have a whole bunch of extra training. Like I had to train for several months just to be able to sell bonds, you know what I mean, to understand their pricing, and that a lot of accountants don't deal with bonds a lot from day to day, and a lot of people who are going into marketing and other sides of business that are required to take accounting never deal with bonds payable. So it's the kind of thing that I just want to make sure you get sufficient information to do well on the exam, but we don't need to, memorize or become experts in bonds.
Yeah, my husband, this is actually what he does for a living.
Mm-hmm.
And so then when he would try to explain things to me, I get frustrated because it's like the level, like the way he would explain it is like way up here, and my understanding is like way down here.
Right.
So I'm like, never mind, you're confusing me more than helping.
And you don't need a very high level understanding right now. What does he do? Is he a broker or is he
He's a cost analyst? So he deals with all the balancing the balance sheet and all that information.
Right, and
And
there's
which is funny because he actually, when he was in school, he struggled with this class too. And he was funny that now this is what he does for a
well,
living.
unfortunately, I feel like so many colleges, and BYU Idaho is definitely one of them. They like to make accounting one. I call it a gatekeeper course. You know, like this hard course that shows whether or not people are going to put forth the time and effort they need to be successful in the rest of the business courses. And so then I get people who are really good at it, but are like scared of it. And they're like, I don't think I could go into accounting. And I'm saying there's tons of jobs in accounting and they pay well. And you don't have to be a genius to do it. I have a friend who's a rocket engineer, and he always tells me that people who can are engineers and people who can't are accountants. But I think that's a little mean. I think it's a little bit of an over-exaggeration. But
He actually graduated from BYU-I.
yeah.
And originally he wanted to do the accounting, but because he was not so confident with this class, and then I guess in the next class after, he switched to management. So he had, in his company, he's the only one that is technically in accounting and finance that has a management degree.
Yeah.
But he still gets paid pretty good money. So that's
Yeah. No, and it's just, it's unfortunate that they make the class so scary. I feel like maybe if they, but I don't know, the only other thing, because what they're trying to do is get you a, I don't know, it's like a buffet, you know, they're trying to let you try all of these different little bits of accounting to get you concepts. So you go it's only an inch or two deep, but it's really broad. And so there's just new concepts constantly. And the only other choice would be to like make it 3 semesters of accounting, and nobody wants that either. So that's the trade-offs. Anyway, okay, well, thanks very much.
Raise my hand.
Okay.
I had just about this whole Zoom recording thing. So I had an appointment with my tutor. And I don't know if it was the last time with me or someone else, like he used a term, I don't know. He had to do something before he could like send it out. Like it had to be, well, paper would be collating paper, but it's not collating. Anyway, I was just wondering if you were having any issues with, there's a term for it, but I can't think of it. Maybe someone else can. Like he can't send me a recording of my Zoom meeting because it's not finished doing what it needs to do such that it can post it.
Yeah, so it does take a little time. I save them to my hard drive and then I upload them to YouTube, just because YouTube will automatically closed caption it for people who don't hear or are hearing impaired. So it does. There's a little window of time. That's like last week. It took me till the next day to get it uploaded or on the site because I had a busy evening, so I kind of stopped it and then put it into upload. Normally I try to do it the same night, but do you need me to send you a link separate from the one
I was just hoping we would get it, and the way he does it before he sends out it's having issues. So.
It takes time is all. No, I save it that way. I create an archive of these. But anyway, Jesse, I don't know when you popped in because my little thing that shows everybody in the class was like down off of my screen. Did you have any questions? I don't mean to.
I do.
Okay.
Homework, but on the second part.
Okay. We may have already covered it, but I don't know when you got here. So hopefully.
I just chimed in.
Okay.
Yeah.
So let me switch over to this.
Has the meeting been going on for a little while?
Yeah, we've been in here over an hour.
Oh.
Are you in Arizona,
okay.
Jesse?
I am, yeah.
Okay. Yeah, I am too. So I've had to, and so's Ging. Yeah.
We don't have daylight savings, so
yeah, we're not the same as.
I thought it. Well.
No, it stays. So I try to keep it at 6 o'clock, like Idaho time, no matter what my time is.
Yeah. Okay. I'm sorry then.
It's okay.
So yeah,
you're still a good person, Jesse. Okay. Let me switch. I mean, I think you are. I don't even know you that well, but you could have me fooled. Let's see. So back to homework part 2. And for those of you that have been in the meeting,
Exercise.
if you need to go, of course you can. I mean, there's nothing mandatory about this, so just letting everybody know. Hold on. No, I don't have a session already running. Let me see if I have another window up.
Maybe Jess's question is good, so I'll stick around for a
Yeah.
little bit.
I'm sure if Jesse's asking it, it's going to be incredible. He's not going to let us down with this question.
I do have a question on bonds and like premiums or like the discount price and stuff like that. Did you guys already talk about that?
Kind of. I think I just confused everybody more about it, if we're being honest.
Yeah, I was reading through there. Like, I guess I don't understand why a bond wouldn't be sold at the face value, but I guess that depends on like how well the company is doing, right?
Well, it
Issues
has.
it.
Yeah, it has mostly to do with. Sorry, I'm having a hard time getting my thing to load here. It has mostly to do with fluctuations in market interest rates. So if I issue a bond, a lot of times companies will issue a bond partially, and what I mean by that is they'll authorize $10 million in a bond issue, but only need $2 million today. So they'll issue the first 2 million, and then wait 6 months, and then issue more. And once the bond is authorized, it already has a set face interest rate. And so if market interest rates have fluctuated in the meantime, then that will cause the bond to be issued at a price
I see.
that is different from it.
Okay. So it's mostly due to timing.
It is, and like I said, market interest rates. So for some reason, you know how when you try to open a second window in Wiley Plus, it gives you like tells you you're naughty.
Mine was doing that before. I think the internet feeds are a little bit. Oh no, mine just timed out on me.
So mine is doing that to me, even though I know I don't have another window open.
I had to close out of mine earlier to start my homework again.
I think you have to.
Because I walked away from my computer.
What I do is you have to go back to the extension link and then reload the page from.
Well, that's what I've been doing, and it tells me.
It doesn't give you the link when you reload the page.
It does.
Not
it gives me the link.
And then you can't click.
Hold on. Sometimes you have to clear your cache, like if it's.
Yeah, if you have too many things loaded, it'll slow it down. It's
still remembering that you were in Wiley Plus a little while ago, and so it's being difficult. So sorry, give me a second.
Do you mind if I share my screen? That way you can see what I'm looking at?
Yeah, let's do that.
Okay. Let me see here. Oh, come on. All right, Casey. You can see this, right?
Yep, I can see your grandma there is pretty excited about you getting married.
So I have a question on exercise 10-13, this last part here. So I got everything else. I'm just a little confused on this part here. So I have bonds payable for the debit account, and then cash for the credit. I'm just not sure what the amount is. Because
yeah.
Go ahead.
So yeah, the amount would be the face value of the bond. So if you issued the bond at 430,000.
So this number.
Right. Okay. Then you were paying 43,000 in interest every year, and then at maturity you have to pay back the 430,000.
I thought it was like a percentage. So 430. Okay. 430. Got enough zeros in there?
I just tell people it's cool if you're off by a zero. I mean, you get fired, but it's cool. Like it's only a factor of 10, right? You're good.
I do have a question on this part here.
Okay. 10 and this is one we did discuss at length, but go for it.
Okay. I mean, I know you guys have been on here for a little while, so I can just watch the video, right?
Yeah, or I don't mind either way. Yeah.
All right. So do I have this correct here? So I have current liabilities, which is a note payable, and the long-term liabilities, which involves a mortgage. And then at the bottom here, it's total liabilities. Is that correct?
No, so what we're doing here is this company has, I think their only liability is this mortgage payable.
Okay.
And so what they're doing is they want us to recognize that when we have a mortgage payable, there's usually a portion of that will be due within the next year.
Mm-hmm.
That's the short term or the current liability. And then there's another, so it should be mortgage payable in both sections.
Two mortgages. Okay.
Right. And so then what you're doing is if you scroll up to where you did
Okay.
I don't know if you can see my thing when I scroll over, but can you see my cursor at all?
You're on my screen.
Yeah, can you see it?
I don't.
Okay, so I don't have control of anything. I just didn't know if you could. So what you see is at the end of that first year, you owe your principal balance is $307,654,
Yeah.
and a portion of that you're going to have to pay in the next year, and
So
that will
this
be
part. Oh no, this part here.
so that's going to be your cash payment, which will
Okay.
include the interest and the principal for the next year. So the reduction in principal in year 2, which is the $70,327,
Mm-hmm.
that represents the portion of that mortgage payable that is due in the next year. So that's the portion of it that's your current liability.
That's a current. Okay. So this 70. That's a current one. Okay.
Mm-hmm.
Okay. Then the long-term one. Which one is that one?
So that'll be the difference between the principal balance of $307,654 and the amount of it that is
Oh, so
current.
that's
That's that amount right there,
this one.
237.
Okay.
Yep.
All right. 237.
I'm interested in the facial expression of this girl whose face is just poking out from your bride's shoulder.
Oh, that's my sister-in-law.
Okay, I thought maybe it was an ex-girlfriend who was sad that you're off the market or something. See, whenever you share your desktop, people are gonna have questions.
I know. Last time I do this. Thanks for staying on.
No problem.
Sorry, I didn't. Okay, so add those two, and then that's a total. All right. Well, thank you.
All right.
Those are my questions.
All right, great.
I'll stop sharing.
Okay.
There you go.
Well, would you be willing to offer our closing prayer since you know you I think if you force the extension of the meeting by a few minutes, that seems like a reasonable payment that you said
Right. Good punishment. All right. Dear Heavenly Father, we're thankful for all of our many blessings. We're thankful for this class and for the resources that we have to get an education. We ask that you please bless those who are sick at this time, that they will be healed and recover quickly. And please bless the rest of us that will be able to avoid this sickness and that will be able to recover from loss of work and any other problems that have been caused by this. And we say this in the name of Jesus Christ. Amen.
Amen. All right.
Thank you.
Thank you.
Have a good night.
All right. Bye-bye.
Bye.